Welcome back to our special show, Rupee, the Fear Factor. We just discussed how the Indian markets are viewing the fall in both bonds and the Indian currency. Joining us now are Nick Parsons, Head Research and Strategy at Thomson Lloyd and Gareth Leather, the Senior Emerging Markets Economist at Capital Economics. Gentlemen, thank you very much for joining us. Nick, well, first to you. You were telling us when we spoke last week that you think the rupee is much stabler than other Asian EMs, and that when the dust settles, people will wonder why the rupee was sold off so much. The rupee has since lost a further 2%. Are we in overshoot terrain? How bad does this get?
Well, we said when the dust settles, they will look at the value in India. And what is very clear is that across the EM universe, the dust hasn't settled yet. You know, here we are, we're less than 10 days away from a US rate hike. We've had strong US numbers on Friday in the jobs with the jobs report, and still investors are preferring the dollar over the EM universe. I think the question's got to be, why has India underperformed the rest of EM rather than just why is the EM universe under pressure? And that's where the puzzle is beginning to lie. Because let's remember, India is now the 6th largest economy in the world. This is not just a tiny EM story. It's the 6th largest economy in the world. We've got bond yields at 8%. We've got a currency which has already fallen 11% this year. And so let's throw this forward and say, how bad do things have to get before people really want to buy into this story? Now, if you look at the 5-year forward rate, 5-year forwards are just approaching 90 to the US dollar. So if you think the rupee is going to be below 90 in 5 years' time, then you must be buying bonds. It's not the case that you must be buying equities, but the fixed income market's starting to look very attractive indeed.
Oh, well, that at least will be music. If some people start thinking that way, then of course you're going to have a bit of a appreciation or a correction in the rupee. But Gareth Leather, let me get your view on emerging markets itself. Now it looks like a double whammy. Until now, whenever the mother economy, the US economy, grew and you had such a strong jobs data, like we did way back in 2003, 4, 5 and 6, the Asian economies celebrated because they were exporting to that country. Now, you can't export as much because of the tariffs and the threat of more tariffs, another $267 billion. Do you think this double threat will mean more discomfort? How much more can emerging currencies fall?
Yeah, we still think the sell-off in Asian currencies still probably has a bit further to go. If you look at the factors that have been weighing on them this year, you've got rising US Treasury yields, you've got the trade war between the US and China, and you've got contagion from the crisis in Argentina and Turkey. Now, we don't see either of those going away anytime soon. So if those are the factors that are driving Asian currencies lower, then it makes sense that they've got further to fall over the next few months, we think.
Okay, so what would you say can be can the dollar go to? The DXY about 95.5. Does it approach 100? What is the number in 2018?
Well, I think we're certainly a long way from that. The sell-off this year, it's been 10%, but if you look at it in a kind of trade-weighted terms, it's much smaller, something around 5% or so. So a lot depends on what happens to the dollar over this period. But we don't see, anything approaching 90. We think that's kind of way off target. Okay.
What about you, Nick? Do you think we're going to see a lot more dollar strength? Because at least immediately the dollar strength, the DXY strength is a matter of concern for EM currencies.
I think near term the dollar may have just a little further to run. The catalyst, I think, for a decline will probably be a change of view on the part of the US administration, and then further down the track, a change of view on the likely path for US interest rates. because you'll find it very difficult to find an analyst who doesn't think that the US will raise rates another 4 times over the next 18 months. That is consensus, that is baked into the price.
Okay.
Once that becomes challenged, once that becomes open to more debate as we move into the start of 2019, then I think we could look at some respite for the EM currencies and the dollar coming off the boil. So I think this may have just a little bit further to run. But my contention for a few moments ago, and I'd repeat now, is that an awful lot of bad news is priced into India, and there's still an awful lot of protection to be found in the yields. Now, I don't think that that same logic applies to the equity market, which is still the world's best performing equity market in 2018. What we perhaps may have to look for is signs that overseas investors begin to exit their equity positions. At that point, they've got no currency left to sell, and rather than looking at the currency market for clues about equities, what we perhaps should be doing is looking at the equity market for clues about the currency.
Okay. Well, actually, there have been a decent amount of foreign portfolio selling in Indian equities for some time now. It's not been massive, but it's been in a trickle. But it's been for a better part of 2018. Gareth Leather, what's your sense? Do we need another external event, like either the Fed saying something, or US and China smoking the peace pipe, or some big data indicating global slowdown for the EM currency to stabilize?
I think you probably need something like that. It's just that we're not anticipating it to happen straight away. I think at some point investors' expectations on US interest rates will change, but I think we've got a few more rate hikes in the US first. The crisis in Turkey and Argentina will probably at some point start to dissipate, but probably not in the immediate term. I think in terms of the trade war between China and the US, I think there's a risk there that could continue for quite a while longer yet, and I think that will continue to weigh on sentiment.
Gareth, if you heard what Nick Parsons has been telling us, he thinks India in particular, the currency and the bond markets are indicating fairly decent value at this point in time. What's your sense? Going by Indian macros, has the rupee corrected enough and are bond yields attractive enough to bring in portfolio investors?
They possibly are, but I think that the big picture is that if you've got this continued sell-off in EM assets, then it's difficult to see India outperforming against this backdrop, especially given you've got the current account deficit, which continues to weigh on investors' minds.
Okay. Yeah, that is there, but the chief culprit over there really are crude prices. And now, you are multiplying probably close to $78 of crude today, 77.5 with 72.5 on the rupee. So that's a big burden for the country. What's your sense in terms of even oil prices? If there is going to be such kind of a tariff war and some quietening of EM growth, do you think oil prices can, go beyond 80, or do you think they are at fair value now?
Our forecast is them to fall a little bit over the next few years, but nothing dramatic enough to kind of substantially change India's external outlook. That, given the likelihood of slightly slower growth in the US and China, we think that will probably weigh on demand, and then increased production in the US will probably boost supply. So you've probably got a slight fall in the oil price over the next couple of years, but I don't think that's going to change the big picture for India, really.
Okay. Well, Nick, a final question to you. Do you think we would be in the midst of some accident? Until now, we've seen, very isolated accidents, like, for instance, within Turkey or within Argentina. It's not, while it is a contagion of sorts, it's not a disastrous contagion. Do you think we are on the brink of something that can be really bad?
It's not my sense, no. I think there are idiosyncratic stories pertaining to individual geographies, but I don't think this is the sort of contagion which ought to drag India down with it. As I said, India is the 6th largest economy in the world. It's going to grow somewhere between 7 and 8% this year. 72 out of the last 74 quarters have produced positive economic growth. And I think when we look at India in comparison to the developed economies, rather than it just being lumped lumped in with the rest of the EM universe, then I think the protection that is already offered there in terms of yield and the extent to which the currency also already has declined is going to make it one of the more attractive investment stories going forward.
Okay. Well, I'm sure this is going to be music to the ears of both the government and the Reserve Bank and a lot of people who are long on the rupee because of their sheer exposure to the Indian economy. Gareth Leather and Nick Parsons, thank you very much for joining me with your perspective on emerging markets and on the global economy. With that, we wrap up this special coverage on Rupee, the Fear Factor. Thank you for watching.